Welcome to The Explainer. Today, we are looking at the financial markets for September 8th, 2025. And honestly, they are sending some seriously mixed signals. It's like a massive tug of war, and we're going to break down exactly what's pulling the market in two different directions at once. So, the huge question on everybody's mind is, what's the real story with the economy? Is it actually strong, or is it about to hit a wall? Because right now, the data is telling two completely different tales, and it's leaving a lot of people scratching their heads. On one side of the coin, you've got this story of pure optimism. We're seeing real strength in certain sectors, tons of companies hitting new yearly highs, and a whole lot of hope that the Fed is going to cut interest rates. But then you flip that coin over, and there's this story of major anxiety. We're talking a classic recession alarm bell going off, not so great jobs data, and these lingering worries about tariffs. Okay, let's dive into that, starting with the biggest red flag that's got everyone so worked up. It's a really weird but really powerful signal coming from the US bond market. And believe me, it is making a lot of folks very, very nervous. It's called a yield curve inversion. Now, normally, in a healthy economy, you get paid more interest for locking up your money for a longer period of time. Simple, right? Well, an inversion flips that completely on its head, and you've got to pay attention to this because historically, it's been one of the most accurate predictors of a recession. So, in a normal world, this is what you'd expect to see. You lend the US government your money for 10 years, and you get a return of about 4.17% per year. Makes sense. But this is where things get strange. Right now, the market is actually demanding a higher interest rate for a much shorter 2-year loan. That is completely backwards. It's basically investors saying they are so worried about the immediate future that they need to be paid more for short-term risk than for long-term risk. Okay, but despite that huge warning sign from the bond market, there are these really powerful pockets of strength that are pushing stocks in the complete opposite direction, and that's fueling a real sense of optimism for a lot of investors out there. And you can see it right here. When we look at how different parts of the economy have been doing since the beginning of the year, it is clearly not all doom and gloom. I mean, some of these sectors are having an absolutely fantastic year with returns way up in the double digits. This chart just perfectly illustrates the divide we're talking about. Look at communication services. That's things like digital ads and streaming. It's up a whopping 25%. Basic materials are right there with it. And yet, at the exact same time, a traditionally stable sector like healthcare is basically flat for the year. Just wow. And this strength isn't just in a few sectors. We're seeing it across the board in individual companies with almost 300 of them hitting new yearly highs. We're talking big household names like MasterCard. Plus, key commodities are bouncing back, and investors are getting pretty excited about a potential Fed rate cut. But for all that good news, there's this steady drumbeat of concerning economic data that seems to be pointing towards a very real slowdown. This headline really just says it all, doesn't it? The latest jobs report came in weaker than everyone was hoping, and that sent an immediate chill through the market. Investors saw that and worried it was the first real sign of the economy running out of gas. And on top of that, you've got the whole ongoing saga with tariffs, the taxes on imported goods. This isn't just a quick problem. Analysts are now saying these trade policies are going to be a direct drag on the entire economy for at least the next couple of years. And this really shows you the conflict in real time. We literally just saw that some commodity prices are up, but this report points out that farmers are actually getting squeezed by super high operating costs. It's a perfect example of how the big, shiny numbers don't always tell the full story of what's happening on the ground. So the really crucial point here is that these aren't just a few random issues. When you pile them all up, a widening current account deficit, which basically means the US is buying way more than it sells, a sluggish growth forecast, and even Wall Street's bets on the future turning cautious, you get a pretty significant set of challenges facing the economy. And all of this brings us right to this moment. The market is just stuck in this tug of war between the good news and the bad news, and it's desperately looking for some kind of tiebreaker, some new information that can finally tip the balance one way or the other. We are in a classic stalemate. The bond market is flashing this huge warning sign of a recession, but at the exact same time, you've got these strong sectors and companies that suggest the economy still has a pretty healthy pulse. The result? The market is just holding its breath. And that new information it's waiting for? It's actually scheduled to be released throughout the day today. At 10 a.m. Eastern, we're getting a look at employment trends. Then at 3 p.m., we'll see what people are expecting for inflation. And finally, at 7 p.m., we get a peek into consumer credit. Each one of these is a vital clue about the real health of the economy. So that's where we stand. Two powerful, completely opposing stories are battling for control of the market. And the big question that leaves us with is this: will today's data finally settle the score and tell us which story, the one of optimism or the one of anxiety, is the right one? Well, we're all about to find out